Hi, banks give you 7% returns, stock markets scare you, so basically you're stuck. You know what? There's a third option. An asset class that gives you 9 to 12% of fixed returns over a fixed period of time with verifiable collaterals. These have been around forever, but until recently you needed a minimum of 1 lakh rupees to invest. You're right, these are bonds. If you've never understood bonds or thought they were too complicated, this episode will change that. Today, we are talking to Ajinkya Kulkarni, the founder of Wint Wealth. Wint Wealth is the platform that made corporate bonds accessible to retail Indian investors. Before Wint Wealth, if you needed 10% returns, you would need some deep pockets and a private wealth manager. Cut to today, all you need is rupees 1,000 and a smartphone. Hi Ajinkya, thank you so much for making the time. It's great to have you with us today.
Thank you, Deshna. Thank you for having me.
All right, Ajinkya, before I start, something out of curiosity. Most fintech startups, finance-based startups, founders come from a banking or finance background, right? I looked into your profile and you are basically a mechanical engineer from IIT. How did that happen?
Yeah, no, I mean, so after engineering, I joined my father's business, which is a press parts business. Then started my first startup. It was an e-commerce venture, but we pivoted to invoice bill discounting. That's how I landed in fintech. Started enjoying it, kept working on it. Worked in a couple of startups in fintech role, and then started Wint Wealth. So yeah, I don't really have any formal degree in finance, but just stayed curious and learned things on the go.
Very interesting. If you could just, let's just go back a little more. I want to understand what was that aha moment when you thought, corporate bonds is the place I'd want to, add value to.
Not particularly bond, but I'll tell you how did I come across this idea. So my last startup didn't work out great. We got acquired, and then I joined Credit Vidya. Then I was at M-Swipe. So I was very clear that what I went wrong with in last startup, and I was very clear, okay, I'll come back, build something big. So I was very focused on figuring out the co-founders, right idea. So I didn't want to waste time learning investing. So whatever money I was saving, I started parking that money in my father's business. He had a bank loan at about 12%. So he said, I'll give you 11%. For me, it was a sweet deal. Liquid hai, ghar ka paisa hai, kahin nahi jayega. And I did that and I moved on. And there used to be always discussion with colleagues कि कौन सा stock में डालना है, कौन से mutual fund में डालना है. And I used to keep quiet and people used to ask me, तू क्या करता है? And I used to tell, मैं तो बापू के business में डाल के बैठा हूँ. And people used to like that a lot. And couple of colleagues actually gave me money saying, हमें भी इसमें डालना है, can you do it? I said, okay. So that's when it hit me saying, and then I started digging deep and realized that Indians have crazy obsession with fixed income products, and all the platforms that are online are equity first. So is there a need for a fixed income platform? That was question number one. We frankly didn't have an answer back then, but what we could realize very quickly is that what people want is this FD plus 2% return, right? Something relatively safer than equity, but gives you about double-digit fixed return, 10%, 11%, very safely, right? And then we started figuring out how can you generate that and then we landed in corporate bonds, right? So that was the story.
Very interesting. I think the reason I'm smiling is I could completely resonate when you said when I first started investing and evaluating your options. I think even my mindset was very similar back then, but yeah, very relatable. So, all right, before we destroy a few myths around corporate bonds and investing, I thought let me set some foundational concepts so that the listeners who are listening in, they could all be aligned on the same page. I can guarantee 80% of the listeners today to our podcast have not invested in a corporate bond. So it only makes sense that we start from the basics, right? If you could very simply explain to me what is a corporate bond, as though I'm not a finance person.
Sure. So very basically, let's say you take a loan, then let's say you take a home loan, right? Then you have certain EMIs. There is fixed interest. There is an interest, let's say 9%, and you pay principal. And there is every first of month, every month's first date, you pay certain amount, right? Now, if basically companies borrow, or like organizations, and like organizations could be government, PSUs, private. If they borrow, then it is in bond format. One of the format is bond, right? The difference, so they can actually take a loan, which is term loan, or they can borrow through bonds. Bond is basically, it's a tradable instrument. You can, like, let's say, let me put it this way. Let's say you have taken a home loan. So bank can very easily sell that home loan to any other bank, then that's tradable. It is not actually in bond. It is tradable. So you can easily sell bond. It is listed. It's like equity. You can sell it anytime. So you basically lend to corporates, companies, organizations.
Right. Got it. So if we take a real example, right, from Wint Wealth, your platform, if you could walk us through one particular bond, just to explain what tenure means, what YTM means, the ratings.
Do you want me to share screen or like?
We can, happy if you could share your screen also, or if you just want to talk about it. Both work well.
Can you see my screen?
Yes.
Yes. So here is this Navi Finser bond, right?
Right.
This bond has YTM of 11%. That means you will get 11% return. Now, if the bond is, there are different type of repayment pattern. Let's say if you, and I'll keep referring to home loan because it is easier to understand. In home loan, you prepay some principal and interest every month, right? So you get interest only on the remaining. You have to pay interest only on the remaining principal, right? So even YTM works like that only. If let's say this NBFC or issuer pays you some principal back, then the interest in the next cycle will reduce because the principal has reduced. But if, let's say, the principal repayment was bullet, then you will get 11% kind of return. So YTM is most accurate measure to like, or indicator to measure the returns, right? So this bond basically is of 11% yield. It is maturity as 22 months. You can also sell it after 15 months. We'll get into that. But for example, like, just it has a plain maturity of 12 months. And you can see repayments, right? So, and here I've selected, just for simplicity's sake, I'll say you buy 1 unit of this bond. So it will cost you about 10,000 rupees and you total get about close to 12,000, right? Now, this principal is at maturity, interest is monthly, right? So every month you get interest, right? And you can see the cash flows. So this is like how your EMI repayment is. So this bond will give you interest for 2 years, close to 2 years, and by 31st December, you'll get interest and also a repayment.
Got it.
Right. So you get 11% return, and now basically this is Navi, which is the issuer name, which is an NBFC. Now this has rating A. This rating is given by credit rating agencies, which are SEBI approved, right? And then we can go into further details of Navi, right? So this company to Wint Wealth investor has repaid already 221 crores. Total investors 1,35,000 plus, 100% repayments are on time. This is the security cover, right? Now, in case of home loan, your home is like collateral. Now, most of the issuers on Wint Wealth platform are NBFCs. In NBFCs, the collateral is generally their underlying portfolio. So they have given out loans. Repayment from those loans is collateral, right? This is additional collateral. At Wint Wealth, we also co-invest 2% and with the intention to hold till maturity. So we thoroughly do our diligence. Our money is on the line. We have skin in the game. So these are comfort points. Then who are the other lenders who have lent to Navi, right? SBI, HDFC Bank, Kotak Mahindra Bank, right? And then we also summarize what are our comfort point and risk that we see, what we like, what we like, low seasoning, regulatory risk. This will be very different for each NBFC.
Right.
And what will be the taxation? So you see all the information here. These are other bond details, right? What was the issue size? Who is the rating agency? Who is the trustee? Where is this bond is listed? This is listed on BSE. When it was allotted? It was in January 25. What is the coupon rate? ISIN, all these technical details also you find, right? So this basically Navi is borrowing through this bond. They are borrowing 170 crore. They borrowed in January 25, 26, and they will pay interest monthly till December 27, and at the end of December 27 they will also pay the interest, right? So that's how a typical bond is like, and you get 11% return.
Right. This is very exhaustive. I just had a couple of questions.
Sure.
The A rating, right? Credit rating, very loosely, we all talk about it, AAA rated, double B, right? What does it actually mean?
So basically, in technical terms, it indicates probability of default. So A rating is low risk, so probability of default is very low. Triple B is moderate risk. Double A are very low risk, and obviously triple are very, very low risk, right? And this triple B, A, and triple B and above are called investment grade ratings, right? So it's basically an indicator of strength. It's basically a third party kind of a view. It is not the only thing that you should look into, but it is one of the view, and these rating agencies are they've gotten some sort of license from SEBI, so there is like oversight and etc. So there is some methodology by which they say this is the strength of this issuer.
Got it. Right. And if I would want to sell it before maturity, for example, there's a liquidity requirement. Is it possible to sell through the same platform?
Yeah. So obviously, I mean, there has to be, it's not guaranteed sale like FD. So in FD, liquidity is almost guaranteed. You can go back to bank anytime and give. Like there will be some penalty, but you'll at least get the principal back, right?
Right.
In bond, somebody has to buy it, right? Let's say this bond has this Navi bond has maturity in 27 December. You want to sell it tomorrow. There has to be a buyer. We facilitate. Generally, there are buyers available, provided the NBFC is not facing any default risk. If bond is gonna default, then who will buy it?
Right.
But we've seen. We were just looking at some like our November data or December data. We have about more than 15,000 sell requests, and we cater to about 99% plus fulfillment rate, and about 80% get the money in same day. Even the 1% are there some technical errors, and we have been improving the flow, right? The main comfort is because we also invest our own money in these bonds, so we keep tracking these NBFCs on regular basis, right? So to buy this bond or sell or to offer it to retail, we instantly know anytime that whether we are going to buy it or not, and we are already ready with some sort of, we keep some sort of money with us to buy fast, and then we sell it down to retail investors.
Got it. I think that's very comforting. I was personally not aware of this part of it myself, so thank you for sharing that.
Yeah.
Just another.
This feature is not available on all platforms. We were the first one to offer it, and we've been figuring out ways to do it more better, because we truly believe that all the other financial instruments are liquid. FD is liquid, equity is liquid. You can get in equity also, you can sell anytime and get.
Yes.
So bond has to be liquid. So and the liquidity is improving as more investors are coming in, right?
Right. Very interesting and reassuring. So yeah. A last foundational concept that I want to talk about, a lot of terms that we throw around, coupon rate, yield, XIRR, IRR, all these popular terms. If you could just simple explanation of how one should think about it.
Don't bother. YTM or XIRR are same, and this is one term that investors should look at in terms of return rate.
Right.
I can get into detail, but there is no meaning. These are all technical. You can get into so many technical detail. Personally, when I look into investing in bond, I will just look at XIRR or YTM. Both basically are same.
Right. Understood. Makes sense, right? So, all right. Now that we've established the foundational concepts, let's talk about a few myths, right? What I'm going to do is I'll state a myth, then give you a little context, and why don't we just discuss this to understand the degree of truth, or how should one think about it, right? Ready?
Sure.
Right. Yeah. So the first common myth is that bonds are only for retired old people. This is a myth, and to add little context from my research, what I've understood is that Wint Wealth has more than 3 lakh customers, right? And majority of them are Gen Zs and millennials. What is the trend that you're seeing, and how is this true, not true?
Yeah, obviously, I mean, no asset class is reserved for any particular age group or someone. Basically, every asset class serves a purpose, right? And typically, where do our young investors come into picture, and why do they think of bonds? So they are typically people who invest already in equities,
Mhm.
like equities, but no, equity is a volatile asset class, so you cannot be parking 100% of the money in equities, right?
Right.
And it's personal choice again. People, somebody would want to invest 5 10 20 30 40% of their portfolio, and they think that FDs give low risk, FDs give very low return, and they're okay with little bit of risk that comes with bond. You can mitigate those risks actually. uh, and so that's when they invest in bonds. So it is not meant particularly for old guys. Even if you're an investor in market, then you need different asset classes serving different purposes, and that's where bonds come in. And so it is even for a 20-year-old it is relevant.
Right. So I'll probably just further down this thought, I'll give you a hypothetical situation. For example, I'm a 30-year-old saving to buy a house in the next 2-3 years, right? The down payment amount, would you think, or how would you think about it? Should I put it in bonds, or should I trade in stock markets or any other asset class? How do you think about it?
Yeah, personally, how I think about for my mental models is, if I don't need this money. There is no like timeline in my mind for the money. Then I will invest in equity. I still believe, especially with the taxation benefits that exist, equity is the asset class to create wealth in long term. But that means at least 10-year plus, right? Between 5 to 10, little debatable depending on personal choices, risk, etc. But less than 5 year, you should not put it in equities. If you are not okay with risk, then FDs are great. If you are okay with little bit risk, you are okay to spend enough time and figure out ways to mitigate those risks, then bonds is a great place. Now you said that you want this money in 3 years, for home down payment, then you could deploy different bond. You obviously have to mitigate risk, and we can get into individual bond risk and bond portfolio risk, etc. But yes, I mean, this is the typical use case that if you need money in certain time period, then bonds can be the place. Or you have money, you don't need it, but you don't want to put 100% equities, then that's where also bonds come in.
Right. I think that that's a clear explanation of how I could develop my own mental model as well. But I'll just put a pin to that thought. I'll go a little deeper into the part where we spoke about diversification of risk, spreading risks across bonds as well, a little into the conversation. All right. I'll move on to the next myth. Okay. So FDs are actually safer than bonds, right?
Yes.
This is a fact. But why should I then invest in a bond? I understand there's a difference in returns, but what is the actual risk that I'm taking for that extra return?
Yeah. I mean, see, actual risk, I mean, I will not get into the technicalities and probabilities. Because that's not how retail investors perceive it, and it's very difficult also to digest. So how I think about it is, if you're absolutely not okay taking risk, stay in FDs. The return, if you see today, FDs will give you about 7.5. These are small finance bank FDs. And in bonds, you'll get 10.5, 11, right? So there is a delta of 3-4%, right? Now, way to mitigate. So there are obviously risks. So if it is A-rated, probability is somewhere around 1% default, right? But obviously this is all category. We do our due diligence, and we have disbursed about 8,000 crore. We have seen zero defaults till date. So there is certain level of comfort that we bring into, because we put in our own money, we have skin in the game, we do thorough due diligence, right? And one thing that investors need to mitigate is, you should put money not in one bond. You should be diversifying at least in 10-20 bonds, so that even if one bond liquidity is hit, etc., and at least other principal is safe. And let's say if you invest in 10 bonds equally, and even if one bond default, the interest will make up and your principal will be at least safe. Right? So therefore diversification becomes very important. right? And it is a tedious thing. We are figuring out solutions on it. But if you can mitigate that risk, so there are a bunch of risks. There is a credit risk, there is a fraud risk, there is liquidity risk, and then there is a concentration risk, right? And all these risks can be mitigated. Doesn't mean that they become zero, but then it becomes what in wealth everybody called is risk adjusted return. Then there is definitely risk adjusted return in bonds compared to FDs, provided you play well.
Right. To understand this a little better, right? ILS, ILNFS, DHFL, and Yes Bank, these defaults kind of shook the corporate investors. What has changed since then? How did you manage zero defaults across 8,000 crores? Do you have a framework of sorts that you follow?
Yeah, I mean, for different industries, we'll have different framework. Let's say let's talk about NBFC framework, for example, because 90% of the issuances are still in NBFC space, right? Leverage is one of the things that we look very closely, right? Uh, if you look at DHFL, ILFS, sitting on very high leverage, right? Then asset classes, complexity of business, right? So we look at who are the backers of this business. Do promoters have enough? Is there a quality of the quality of management team? Basically, can promoters go on raising debt? What is lender profile? Is it well diversified? Is there enough depth of these lenders? What is the profile of equity investors who are backing them? Can they support the company if there is a bad credit cycle? And there are bad credit cycles, obviously, right? So there are so many checks and balances that we do. So we start with basically what is the leverage, and then what are the NPAs or defaults of this particular MBFC compared to the category they are in, then quality of management team. Then we actually have a lot of market intelligence, on-ground visits to figure out are the numbers truly reflect the ground reality, and then that's when everything we have comfort with, that's when we go about it. But baseline is we stick to triple B and minus. We go with NBFCs where they're professional investors, corporate governance is not an issue. Promoter has very good reputation in the market, and then details of the asset class and portfolio cuts, etc.
Right. So, the due diligence that you do, right? How does that convert into me, suppose a retail investor, if I'm evaluating purchasing a bond? Where do I have to look up all this information? I understand there's a report that you publish. Is that where you share all of this?
No, we don't publish this report, but because we get a lot of hold to confidential data, and also we may not be directly from NBFC or from, let's say, third parties, but we do mention in the screen I showed, right? There are comfort point and risk point where we summarize this in very basic detail. And if we don't have enough comfort, then we wouldn't bring that bond on the platform, right? So
Understood. So, okay, so I'll just repeat what I understand, right? So the platform that we saw, the summarized version of all your analysis was available. Apart from that, there's a CRISIL rating also that is available.
yes,
Combination of that should be sufficient to make a decision whether to invest or not.
yes.
Right. Got it. All right. Okay, I'll move on to the next myth. Right. You need a lot of money to invest in corporate bonds. This is the myth. It was the case, I think, until a few years back, where you need a minimum of 1 lakh rupees. That amount is now down to rupees 1,000, right? How does one think about this? Is that factually correct?
Yeah, I mean, till 2022, most of these high-yielding bonds, the minimum investors was 10 lakh actually. Then in 22, it became 1 lakh, and now in 24, it became 10,000. Right? There are some bonds even at 1,000 ticket size. These are not very high-yielding, right? But what retail investors get attracted, these bonds are now available at 10,000. So obviously, regulator has opened the market, and that has played a big role. So now it is not, obviously at 10 lakh it was not a retail product, but at 10,000 it's definitely a retail product.
Got it. So the point that we spoke about a bit earlier about spreading risk across different bond types, right? let's assume I have about 5 lakh rupees to invest in bonds. How would you give me a mental model or framework about how do I diversify across the bonds that are available?
Sure. One of the mental model I personally believe still exists is like what stocks were probably 30, 40 years. That's where bonds are today. So that means there is a lot of information arbitrage, right? Not all the information is available in public domain. Obviously I'm not a public market investor or stock investor myself, but what I know now is that all the information is right available in public domain. That's not the case with bonds yet. So like you need to have some expert vetting it. And our way of doing that was having our own skin in the game, because that basically is the biggest indicator whether you have done thorough diligence. Because even if I publish, let's say, 100-page report, doesn't mean much if I don't have skin in the game. Now, I will still be very wary of investing if there is no skin in the game. Because you don't know, debt is such a complex thing to underwrite, and not all the information is in public domain. Second, if there is a skin in the game and I'm satisfied with the platform's due diligence, basis water history, or probably reading documents, etc., then you need to diversify well. At least invest in 10 bonds. So if you're 5 lakh, I'll say invest probably 50,000 in 10 bonds.
Got it. Understood. There's no sector specification or something that you would...
You can. I mean, many investors on the platform, after our selection criteria, if there are, let's say, 50 issuers, they will certainly say that, okay, I want to only invest in NBFCs which are secured loan portfolio or which are A-rated. There will be certain criteria that investors also build in, and that's perfectly fine.
Right. Just for
I'm saying, without some investor vetting it very strongly, you can't really build your own criteria. You can build criteria once they're vetted. Is the right way of, from a retail investor's point of view, in my opinion.
Got it. Two questions. First is that at any point in time, on average, how many bonds are live on Wint Wealth? Just to
at least 15-20 in general.
Okay, 15-20 in general are available. Okay. And the other thing that I wanted to understand was the information to public, right? Is this something that you see getting democratized in the near future?
Yeah. I mean, as the disclosures increase, as more NBFCs or more issuers come in the market, this will, in next 5-10 years, probably just matter of time. I'm not really sure on the timeline, 5 or 10 or 15, but it will obviously.
Right. Thanks for sharing that. Yeah. I'll move on to the next myth. This is something that even I was guilty of thinking, bonds usually have a fixed return, right? Why not, if I am willing to take that risk, why not invest in stocks instead? This is a mindset issue, but yeah, I'd love to hear your thoughts on that.
Yeah, I mean, as we spoke about, right, every asset class serves different purpose. Stocks give a higher return and higher risk. So they're not either or, it is basically and, right? You need stocks or equity mutual fund better for retail investors, and bonds, right? So in that sense, both serve a very different purpose, right? So you can't really replace one with other.
Right. It's basically not an either or, it's going to be a combination of
yes
classes. Fair. In today's scenario, with repo rate at about 5.25%, inflation not that high, what is your take? Is it the right time to book in money with bonds, or should we wait for a little longer?
No, I think I personally believe that you should follow diversification. At every time you can invest in bond, that's not a problem. And even in equities, you can, personally, I believe in continuing SIPs through, right? And so, see, all the timing in the market only makes, gives you yield or results if you're expert, and you have to do asset allocation first. right? And you have to set everything else, and then timing probably can create that delta. If you haven't started in bonds or you haven't started in equities, this is the right time. Start with very low amount, understand the asset class, because whatever you do, whatever podcast you watch, you ultimately understand the asset class by investing in it. So you start small, you look how that asset class you understand in 5-6 months, and then you slowly start doubling down. So in that way, I don't really believe that at this repo rate it makes sense and at this repo rate it doesn't make sense.
Got it. All right, I'll move on to the next myth. Credit rating tells you everything you need to know about a bond. I think we spoke about this very briefly. Let's go a little deeper, right? ILNFS was AAA rated until a few days before the crash. How would you recommend our users think about it?
Yeah, I mean, as I said, ratings don't indicate everything, and I'll give you very simple VA. So ratings actually give probability of default and not probability of loss,
Okay.
right? So let me explain. Let's say a AAA rated NBFC issuing a secured bond and unsecured bond, both rating at AAA.
Mm-hmm.
What that means is whenever that repayment date is, the probability of repayment is very high for AAA. It is lower than AAA. But let's say if it is unsecured bond, then probability of loss is very high.
Okay.
Because if that bond defaults, she will not be able to, very unlikely that you will get your money. In secure asset, there is some collateral, you will sell that collateral, you will recover money, and that has happened in the past, right?
Right.
But that is not measured by ratings, right? So rating is one indicator, it is strength of the company, but you need to look at other factors, security, whether this bond is secured, right? So bunch of these other factors. So rating is one indicator, but it's not the only indicator.
Right. So when you said this demarcation about secured versus unsecured bonds, right? Is it evident? Is it mentioned somewhere when I'm buying a bond?
We have recently started doing some unsecured bonds, mainly because there was a lot of investor interest of that. Most of the bonds we do are secured.
Right.
If you do unsecured, we mentioned on the page.
Okay, so it is got it. All right, I'll move on to the last myth. If bonds are so good, why doesn't everyone invest in them? This kind of the devil's advocate kind of mindset where I'm, until 2020, before your platform came in, I don't think so there was a way for people to buy it as well, right? So why after 2020 is when we started, why did corporate bonds get the required visibility?
No, I think it is mainly because of the regulatory unlock. The ticket size was for high yielding bond was 10 lakh rupees. So obviously, nobody would sell it. Then it became 1 lakh and it became 10,000. So it is mainly because of regulatory push.
Okay.
And every market takes its own time for maturity. I mean, for a long time, like you see, probably 10 years back, our demat investors would be about 2-3 crore. Now they are 10-12 crore, right? So it takes time. Economy has to reach particular per capita GDP, and then things starts unraveling.
Right. So mutual funds are usually distributed through your DSAs. FDs are done through banks, right? There is an incentive tied to whoever is getting in that business. For corporate bonds, my understanding is we don't really have that kind of a sorted ecosystem yet. Is that a fair statement?
Yeah, but regulators, we have a OBPP association, Online Bond Platforms Association, and we've been talking to regulator on this front, and we hope to see some positive developments in coming future.
Right. So currently your incentive, in fact, I would, the way I'm looking at it, you said you put 2% of your funds also for, in the example that we saw. It's more like you are trying to build that trust, and you have more at stake right now than an incentive
Yes.
to sell it. Right? Fair. Okay. You're definitely scaling. Wint Wealth is doing a great job at it. And what's the end game that you see? Are you seeing that, every retail portfolio would have around 10-15% of investment in bonds, or how do you envision it?
Yeah, I mean, bond as asset class is going to hopefully replicate what equity trajectory was in terms of number of investors investing in it. And we are the largest platform, so we'll be the beneficiaries of it. So that's what we are hoping. We don't really want this percent allocation etc. Our job is to educate and then let investor figure out what is best for them. So we'll basically tell, okay, the bond serves this purpose. If you want something in this asset class, here it is.
If we were to make a prophecy of sorts today, right? FDs, I would think that in fixed income, FDs are the strongest competition to bonds, right? If there there are 200 lakh crores sitting in FDs today with people, mainly I feel because it's a access issue that people are not really aware. Like you said, your efforts have been in that direction. Is that a fair statement to say, or how do you think, are we going to compete against FDs in terms of bonds competing with FDs?
You could say for some angle. You would say people will get more options and
Right.
then they will choose. Right. People still, I don't see that people completely abandoning FDs. They have their own purpose, right? But yes, bonds will see some share of wallet going up.
Noted. All right, I think these were the main myths that I wanted to talk about. Now, a very quick segment, rapid fire. You can answer in a word or a sentence, right? And I'll keep it simple. The best bond tenure for a beginner.
Lesser the better.
Okay. Worst mistake that first time bond investors make.
Invest too much money in single bond. First is invest too much money to start with. You should always start small and then not diversifying.
Got it. One NBFC whose credit quality you respect the most.
Many of them. I can't name one because we've done NBFC issuances of 50 plus NBFCs, and I can't really say one is best.
Got it. The one biggest lesson you learned while running Wint Wealth.
Many lessons, not one big.
Okay. One investing book that you would recommend our listeners read.
I personally learned a lot by reading Psychology of Money.
Psychology of Money. Got it. All right, I think I've completed the important bits of it. Now, just to wrap up, I'd want to spend a few minutes understanding, if we'll just create a blueprint of sorts so that a person listening today can have some actionable insights to go and implement today, right? So if someone has never invested in a bond and they want to start doing so today, can you give us a step-by-step approach?
Start small. Many bonds come with 1,000 ticket size or 10,000. And then as you gain confidence, invest in multiple bonds, diversify in 10 bonds. I would personally and maybe it's biased because I'm running into it, but if platform doesn't have skin in the game, I would not just simply go by rating and the information given. Debt underwriting is pretty much complex, is what I've realized.
Right. So probably go to the platform, understand a bond, the tenure, YTM, rating, and special notes, and then make an informed decision. Start small is the other point that you said.
Yes, and if platform doesn't have skin in the game, then you are on your own and it's a very risky territory to be.
Right.
Or then go to some offline expert that you think knows about bond and can analyze bonds and choose.
Okay. Just to talk a little more about this offline expert, right? Is there a designation? How do I know them?
No, there's no bond expert designation. I'm just saying, go to some expert who knows it.
Got it. All right. The one point I think we missed talking about is how are bonds taxed? Is there some mistake that commonly bondholders make?
No, these are taxed at your marginal rate.
Okay. And that is around 10% long term?
No. If you're in 10% tax bracket, it is like additional income. Okay. So if you're in 30%, it will be taxed 30%. If you are in 10% tax bracket, it will be taxed 10%.
Right. It is so tenure, all that doesn't play a role in determining. your taxes. Got it. All right. 3 signs that a bond is too risky. If someone, a noob also at selecting a bond, if there were 3 signs they should look out for.
One of the signs that you can clearly see if the rating is high but yield is also very high. For example, when DHFL was gonna default, 1 month before that it was borrowing at 11%ish. AAA rated. So if let's say, but again it's a very technical thing.
Right.
Like you need to know what is the yield spectrum for particular rating, and it is not just on rating, asset class, etc, and then how much is the deviation. But there is, if market is perceiving the rate, it is a very risky bond, then obviously yield goes up.
Right. I'll just spend a little more time on that, right? For AAA rated bonds, what would be the spectrum generally?
It will be like your FD, probably less than FD.
Less than FD. AA, how much improvement can I see?
Depends on the range, asset class, but 1 to 2% higher than FD.
1 to 2% higher than FD, and I think BBB.
A will be about 2-3% higher than FD. BBB will be 3-4% higher than FD.
Okay, so this is one signal. Any other signals that I should look out for?
There are many signals, but these are very subtle, and these signals cannot be just unilateral signal. You look at it, bunch of other things. So I can't really signal out.
Got it. Understood. All right. I think perfect. I've gotten all the, we've busted a lot of myths. I'm sure that the listeners would have a lot more clarity about bonds today. Thanks to you, and appreciate you taking the time, sir. Thank you.
Thank you. Thank you, Deshna. It was a nice conversation. Thank you for having me.
That was Ajinkya Kulkarni, 3-time founder and the person who made corporate bonds accessible to retail Indian investors. Here's the truth. Indians have more than rupees 200 lakh crore rupees sitting in FDs, earning 6 to 7% returns. Corporate bonds, on the other hand, yield 9 to 12% returns and have verifiable collaterals. We don't have a logic problem, we have an access problem. Now that you know better, what are you going to do about it? The gap exists because of access and not logic. Now you know how to bridge it. The question is, will you? Until next time, this is Money Without Myths. Choose wisely.